computer. I'm Justin Botillier, CEO of Calyx CPA in Medford, Oregon, and with me I have Michael Brooks. He recently applied for a service center license here in Oregon, Roots to Sky, and you contacted me with some questions, and they're questions that I frequently get in the psilocybin industry as it rolls out here in Oregon. And I thought, and I got permission from you, Michael, thank you so much, to record this meeting and then be able to pass it on to other people who might have similar questions. And the questions that I'm about to answer are questions that I frequently get. And I thought that instead of having the conversation over and over again, I could maybe put it out there in this format. So the first question that we will be addressing is 280E and how it affects the psilocybin industry. And I can talk on the various businesses in the pipeline. The most impacted is going to be service centers because they're, so 280E is a IRS code penalty that was put on businesses in trafficking industries by Congress back in the 80s during the war on drugs that does not allow you to deduct your expenses, your business expenses, except for what's called cost of goods sold. And that was because there was pushback during that time that that Congress had to allow, because otherwise it would be violating the Constitution of only having to pay taxes on income. So income is essentially the money that you bring in, your gross income less your product costs. Everything else is considered discretionary. So cost of goods sold is what we are allowed to deduct. And you can imagine that in the manufacturing and cultivation, most everything is going into the cultivation of income. So, or the cultivation of the product that is then sold for income. So we consider most of what, like say a farm accumulates or spends its money on as a product cost or a cost of goods sold. And so they're impacted a lot less than other areas in the pipeline. So service centers are more closely related to how like the cannabis dispensaries are, where in the cannabis industry, a dispensary is allowed to deduct its purchases for resale, and that's it. So they have their gross income minus their purchases for the product that they're selling, and then they can't deduct anything else. We have devised a couple of ways to help those businesses, and I will talk about those shortly because they apply to the psychedelics or the psilocybin industry as well. But essentially, service centers only have very little product cost because the cost for the psilocybin is a lot less than what they are charging for, say, facilitation or the room rentals and that kind of thing. So if the IRS comes in and says that 280E applies to a service center overall, then they're going to say, well, you can deduct the few $100s that you paid for the medicine for the sessions, but you cannot deduct anything else. No facility costs, none of the payroll or the facilitator costs. And so that would be devastating to a business, right? That would be like to not be able to deduct your costs would just be everything. It's almost on everything. So that is absolutely completely unreasonable. And unfortunately, there are, due to the path that cannabis has laid, and for those of us who've been in the cannabis industry a very long time, we know 280E very well and how to address it to make sure that your the fallout or the impact from 280E is mitigated as much as possible to allow you to stay in business and be profitable. So there's a lot of information in the ecosystem about the various methods that can be implemented to not circumvent, but to handle 280E. A couple of those is, well, one is to separate services from the sale of the medicine. And that actually is a defensible approach. It has been argued in tax court before, assuming the circumstances are similar. And this, of course, is a different industry, and the circumstances will be different. But there is a court precedence called Californians Helping, Alleviate Medical Problems, which the IRS audited a nonprofit and they stripped that organization of its nonprofit status. And what it was doing was providing caregiving services while at the same time providing medical marijuana. And so they came back and said, hey, the whole business is subject to 280E, and therefore we're going to disallow all of your deductions, including your payroll that is associated with the caregiving aspect of it. So it bankrupted them ultimately, but they came back around and argued that, no, you can see that we have two buckets of income. One is for the cannabis, one is for the services that we were providing, the caregiving services that we were providing, and therefore we should be allowed to deduct the caregiving, the expenses related to caregiving. And we agree that we won't deduct the expenses related to the sale of cannabis. So the tax courts ruled in that organization's favor, thus setting precedents that we could, and none of this is tried and true, and the only way to do that is if one day one of you gets picked up and you take it to tax court. That's the only way we're going to know. However, I feel like 280E potentially is on its way out, and therefore I'm not sure how long it's going to burden you, and therefore will that allow time for that to go away before we have to deal with it like this? This is kind of a question, and I can talk to you a little bit, Michael, I could talk to you a little bit later about the federal environment around 280E and the potential of it being overruled due to it being unconstitutional. So that's another conversation we can have. But let's see, where was I? Oh, champs. So one of the methods that have been proposed is that we use like a two business bifurcation of the organization. We have a facilitation business, and then we have the service center. And the way that structure would look is you would have the service center that maintains the facility, the licensed facility. It would be responsible for selling and administering the psilocybin. So it would be truly the plant touching business. Whereas the facilitation business or the service business would be providing the services. It would not touch the medicine, and therefore would be considered not subject to 280E. Okay. And attorneys have been promoting that for that method, and it also provides a little bit of legal protection. But on the downside, if it has substantively similar ownership, then an attorney could just be like, I'm going to sue that business, and I'm going to sue this business, and I'm going to sue the owners, and I'm going to put everybody on that docket to sue. So the question is, does it help? I'm not sure. I haven't seen the litigation happen yet, but it is a method. Okay, the other way, and I'm going to just come right out right now and tell you that it's my preferred method at this time, having kind of gone back and forth for a long time now, since I first started really thinking about how to handle this, and now getting into the practical, now that we have practical experience working with service centers, doing their bookkeeping, working with them on their invoicing, trying to keep it all, like working with companies that have two businesses versus just keeping it in one. I am leaning towards the one business, keeping it all under one business. Okay, so in the cannabis industry, we've been using a code section called 471C. And originally 471 is a code section that was imposed on manufacturing businesses. And what the IRS was trying to do was force manufacturing business to take their overhead costs and capitalize it to inventory, thus forcing them to not recognize their expenses until until their product was sold, and then in which case then you can take the inventory expense as cost of goods sold. I know that's a little bit highbrow. It's a very for some people, it's for most people, it's very complicated idea. But before, but the important part is what's happening is with 471 is that, and back in the day, before, before say 2018, or before marijuana even was, coming onto the service as a legal business, it was a penalty. It was the IRS trying to get manufacturing companies to move their overhead costs into inventory. Thus, it would eventually get deducted, not immediately, but shortly after the product was sold as cost of goods sold, and therefore it's deductible under 471 and 280E. So for a long time, we in the cannabis industry, when we were working with cannabis companies, saw that and we're like, haha, we're going to take your code section that you imposed on manufacturing companies and told them that they had to use it, and we're going to use it. So what we did was we would take part of our overhead costs and we would apply them to inventory and thus be able to ultimately deduct them as cost of goods sold. That worked for manufacturing companies. We did do that with dispensaries for a while, but it was a lot less defensible during that time. But fast forward to 2018, during the Tax Cuts and Jobs Act, they passed what's called 471C, which superseded 471A, which was the original code. And the intent of 471C was to simplify the inventory methodology so that all businesses can choose what inventory methodology they use. Even retail businesses could now use 471, and therefore even dispensaries could now legally take their overhead, allocate it to inventory, and thus deduct it as cost of goods sold. And the language is very simple. As long as you're a business under $29 million, you can choose to calculate your inventory based on your books and records. It's that simple. Okay. As long as the methodology matches your books and records, you are allowed to use 471C, and you can take your overhead, apply it to inventory, and then therefore deduct it as a cost of sale, as a cost of goods sold. So I prefer using that. Now, there was some regulation that was put down by the IRS after they realized that 471C became a loophole for cannabis. They tried to pedal back. They created regulation that said if an expense is otherwise disallowed by another code section, then you can't use 471. And that would ordinarily be a game changer, and it did deter a lot of people from using it. A lot of accounts were like, oh, okay, we can't use that. But after getting together with my tax attorney colleagues and we did a deep dive into it. There's nothing in 471 that says that it doesn't have that language. There's another code section, 263A, that has that same language or something close to it that the cannabis industry knew about years ago, but we did not use it because it said if an expense is disallowed by another code section, you cannot use 263A. So we landed on this code section 471, and we've been using it ever since because there's nothing in there that says we can't use it. And so the IRS did put down some regulation, which is important to understand that regulation is not tax code. Regulation is the IRS's interpretation of the tax code, okay? But it's not tax code, just like we interpret the tax code. And regulation is designed to help us as accountants understand the tax code. And so when we saw that regulation, that wasn't helping us understand the tax code. We know what the tax code said. They were simply responding to pressure by their governing bodies in order to deter the cannabis industry from using 471C the way we are currently using it and have been using it for close to 5 years, or five years now, by now, since 2018. So I guess what I'm saying is that you can use that and you can do it legally. And I've heard that the cannabis industry is avoiding litigating 471C, and there have been audits that they have not argued the position. They don't want to do it because it actually does, 471C works. Okay, so from my perspective, the IRS is going to come in and say, okay, this is a trafficking business here. This service center and everything around it is a trafficking business. The facilitation is all in the service of selling psilocybin. The facility is in the service of selling psilocybin. This is all just a business that is selling psilocybin, and therefore it's all subject to 280E. And then that's when we as accountants say, okay, in that case, we are going to allocate to inventory our overhead based on our books and records. We're going to keep track of inventory, meaning you're going to keep track of the grams or the milligrams of psilocybin that you purchase. We're going to count the grams or the milligrams of psilocybin that you have on hand at the end of the year. And then we're going to prorate the inventory based on what is left on hand to inventory. And then we're going to deduct all the rest of those costs. Okay, now that is where I might have to explain more at a different time. But if the books and records say facilitators are deductible, facility costs are deductible, if licensing is deductible, if the security system is deductible, if the payroll, if a lot of the payroll is deductible, then that's all going into inventory. We're going to move that all into inventory. And then we're going to deduct it as a cost of sale, which it kind of all is, right? Because if really what you're selling is a session, well, what is the cost of the session? The facilitation is the cost of the session. The facility is the cost of the session. And part of the licensing fees are part of the session. The utilities are part of the session. All of these things are part of the session. So we have every right to put them into inventory and then deduct them as a cost of goods sold. They are not disallowed by 280E. Okay, there are some things that would not be allowed by 280E. We're not going to deduct professional fees. We're not going to deduct advertising. And there's some other ones that are usually smaller, but those are the two big ones. Advertising and professional fees, they're discretionary. They're very admin-y. They're not like, we can't say like advertising as part of cost of goods sold. We can't really do that because it's not absolutely required for providing the service or selling the medicine. Okay, so If the IRS comes back and says, no, we don't agree that facilitation is cost of goods sold. We don't agree that the facility is cost of goods sold. Those are all subject to 280. Then we'll come back and then use Californians Helping Alleviate Medical Problems and say, okay, well, if you're saying that this is not part of, if this is not part of the sale of the psilocybin, then it's a service. So either way, I think the psychedelics industry has this in the bag. You know what I mean? So there's a lot of misinformation going out that it's not a matter of if, it's a matter of when you get audited. You're going to have to do all these complicated things in order to get all your deductions. You're going to need to take incredible record keeping in order to get your deductions. I don't think that's true. I think that there is some complexity in it. The tax returns need to be done really well with the right disclosures. But other than that, I don't think that 280 is going to be a heavy burden on the psychedelics industry. We're recording this meeting so you can listen to this over and over again if you want to. So as far as the entity type, LLC is a legal entity. That is the preferred legal entity of almost all businesses nowadays. But that's a state legal business. That's a legal entity. And that's not a tax entity. Okay, so that's important. An LLC is limited liability company. It is an entity, it's a legal entity at the state level. And now an LLC can be taxed as a few things. Okay, there's only like 4 options. One is a sole proprietorship, or what they also call a disregarded entity. So meaning no tax entity. It just gets put on your personal tax return. If there's 2 or more people, owners involved in the business, then its default entity is a partnership. So it's an LLC being taxed as a partnership. Then you've got the S corporation, which is a pass-through entity, which means, so partnerships and S corps are what are called pass-through entities, in which a business return is filed, the net income is determined, and you get what's called a K1. It's a form that you get from the accountant after they prepared the business return, and then that K1 goes on your personal tax return. So it doesn't matter if the money stayed in the bank or it got distributed to the owners, it gets taxed. The net income gets taxed. Partnerships get taxed less favorably because of self-employment tax. Sole proprietorships and partnerships have what's called self-employment tax, which is an additional tax. Then S corps do not have self-employment tax. They're a little bit more rigid, but they are also pass-through entities similar to partnerships. Each one of these has its pros and cons. Then finally, the one that I'm recommending for service centers is the C corporation. I think the C corporation is going to give you that extra level of protection for the IRS in case the IRS comes back and says, you know, that Justin was a quack. He didn't know what he was talking about. He put all of us at risk, and now the IRS can come down on you and then take you to tax court and audit you, and just everything's 280 now. Everything is, you know. So I'm not saying that that's going to happen. In fact, the probability is below, you know, 0 point something percent. It's very low of something that catastrophic happening. But if it did happen, a C corporation pays its own taxes. And therefore, if the IRS were to come in and say like, okay, no, all of this is subject to 280E and you now owe $1 million in taxes, it stays in the corporation. Okay, it doesn't pass through to you personally. And that's the important part right now, because we don't know. We don't ultimately know. I'm very optimistic, and but the realists would say that you need to protect yourself with the C corporation. It pays its own tax. You get audited. They assess tax. It stays in the corporation, where you still get, as the owner of the business, the ability to pay yourself a payroll. It still is allowed to pay all of its bills. It's still allowed to go on doing business. And then what is left over, you can pay the IRS with that. So before I get into banking, let's talk about that, the way I see what's going on with 280E as of right now. Okay. So the HHS is rescheduling cannabis, right? From schedule, or they recommended that the DEA reschedule cannabis from a Schedule 1 to Schedule 3, which really does nothing but takes away 280E. Okay, so for cannabis, they're saying that cannabis does have medical benefits and is not addictive, whereas Schedule 1 is, it does not have medical benefits and it is highly addictive, similar to meth, and other crack cocaine and terrible things. So obviously they have that wrong. And now the HHS is saying, Health and Human Services is saying, it should be a Schedule 3, not a Schedule 1. And we now have a conservative Supreme Court justice, conservative court justices in the Supreme Court. Don't look into my political beliefs. Don't try to interpret my political beliefs by what I'm saying or my leanings. But the truth of the matter is, you've got 6 conservative Supreme Court justices in Supreme Court right now. And they, for crying out loud, overturned Roe versus Wade, which signals that they are definitely leaning on more of a states' right interpretation of the Constitution. Okay, so back in 2005, there was a case called Gonzalez versus Reich, and they pretty much said, hey, cannabis is totally an intrastate commerce thing. Okay, this is in the state, it's not out of the state. Okay, so so therefore, by enforcing federal drug enforcement laws on the state, you are violating the interstate commerce clause of the Constitution. Because really, the government only has the ability to regulate issues that have impacts outside of the state, cross-state impacts. And what they said is our medical program, this is 2005 when it was just medical, this is an intrastate issue. And the Supreme Court at that time said, no, we have to be able to enforce drug policy throughout the whole United States. So the circumstances were completely different. You had only a handful of states that had medical programs. Now, there was one dissenting Supreme Court judge at that time, and that was Clarence Thomas, who's a conservative who is still on the Supreme Court now, and now he has friends, whereas before he didn't have friends. Okay, he said that this is a violation of, I don't know what he said exactly, but what I gathered was he said this is a violation of the Interstate Commerce Clause. So assuming they're revisiting that now that the environment has changed, now that we have 36 cannabis programs out there, the states with cannabis programs, they've done a multitude of things kind of demonstrating that the federal government is saying it's a state issue. Why was cannabis still part of the Controlled Substances Act at that point? Why was the IRS and the government still enforcing drug regulations on the states that had medical programs or recreational programs and subjecting them to 280E when everything else was saying, hey, it's your business. You can conduct business with your cannabis program any way you want, except for we're still going to penalize you with 280E. That doesn't make any sense. So I believe, and there's a group of us that believes that 280E is going to be overruled as unconstitutional for states that have programs. And psilocybin should also be part of that. Now, fortunately, using these methodologies, 471C, CHAMPS, your impact, 280E impact should be very little. And if you want to, we might be able to argue that it's a state a states' rights thing and potentially not reduce deductions for 280E. We just have to put disclosures in there, but I'm not ready to do that yet because it's a little too soon for that. So that's something that I thought I would throw out there. Okay, banking. Citizens Bank, I think it's called right now. There's a National Psychedelics Association. If you look them up, if you become a part of the National Psychedelics Association, they will hook you up with Citizens Bank and some other resources for banking. They don't allow you to put cash for the sale of the psilocybin. You will still have to conduct business with cash, but only to the extent that you're buying and selling the medicine. So you're going to need to take out a few $1,000s. You're going to go buy it from the mushroom grower. You're going to buy the medicine from the mushroom grower with cash, and then you're going to sell it to the clients in cash. You're going to accept cash. So there will be some cash management that will be required. For facilitation, for services, for room fees, you can use merchant services. You can use other traditional banking forms to be able to do that. So you will need to invoice your clients. I recommend you use QuickBooks online. You will need to invoice your clients, but you'll divide the invoice up into three things. You'll divide it in sales, medicine sales. You will have to collect tax, some sales tax. Oregon does have a sales tax. And then you're going to collect money for facility fees. Now, if you have another business that's a facilitator business, or a lot of my clients actually subcontract, or not even subcontract, what they do is they provide the medicine and they provide the facility, but then the facilitation is paid for separately by the client, and it doesn't pass through. And that's a pretty good strategic move to do it that way. And that's where having a facilitation service also kind of works, because then the client is going to pay the service center for the medicine. You're going to collect tax. You're going to pay the room expense, the facility expense, but then they're going to turn around and pay the facilitator money. And they can use, Square or whatever. The facilitator should not have a problem getting banking. All right. So that was big. I'm going to go ahead and do you have any related questions to what we talked about? And then I'll go ahead and stop this video if we want to go in a different direction.
Yeah, no, you've answered the questions that I posed earlier, and I'm very thankful for you taking the time to answer them for me.
Right on, right on. Okay.